Here's the first take on the index. Just consolidating its gains really. So the Nifty at that 18,400 mark.
The mid-cap index is up nearly 1%. Very strong advance decline ratio. We've got nearly 1,900 stocks gaining in trade.
Quite choppy right now. We've fallen from the highs and right now down 34 points on the Nifty.
Yesterday it was looking good. It was looking up and up. The market did correct in the last 30 minutes. Some hesitation right at the top. And today it's seeing a bit more of that pullback extend. Going to end down 120 points on the Nifty. 18,278 is where we will around where we will stop today.
Hello and welcome to Markets Today, the show where we track about 6 hours of the day's trading action in 5 headlines. I'm Sonal Bhutra. Here are the headlines for today. A late sell-off on Dalal Street. Sensex drops over 400 points and Nifty loses 120 points to end at the low point of the day. Mid-cap see marginal losses. Bharti Airtel's Q4 numbers come mostly in line with estimates, but revenues miss estimates marginally. Earnings corner now. Bank of Baroda and Suryoday SFB perk up on a strong Q4. Astral rallied 7% after revenue soared 8%, and most importantly, it was an operational beat. IOC gains after it beats estimates on all counts, and Vesuvius gains 20% after EBITDA rises 65% on a yearly basis. Berger falls despite a mixed bag in Q4. Kalyan Jewellers gains after revenues and EBITDA saw healthy growth, while PVR reports a net loss of over 300 crore rupees. ONGC and All India gain after the government cuts windfall tax to nil from 4,100 rupees per ton. A fire at Alberta oil fields in Canada and US purchasing crude to build inventories also fuels the rally in oil producers. Here's the lineup of what we have in store for you. It's a packed show today. In the market opinion, we have Dean Kim, Head of Global Research Product at William O'Neill, and Atul Suri, CEO Marathon Trends PMS. In Big Corporate Voices, we have Ramesh Kalyan Raman, the Executive Director at Kalyan Jewellers, and Ajay Bijli, MD, and Nitin Sood, CFO at PVR Inox. Straight to the day's trading action now. Last hour fall saw the markets close at the day's low. Nifty and Sensex ended over 0.5% in the red. A big fall in HDFC and HDFC Bank weighed on the market and dragged the Nifty lower. Nifty is back below the 18,300 mark. Broader markets outperformed the blue chips. Prashant Nair is here with the details. Prashant.
You know, there is an old saying that the market does the most expected thing in the most unexpected way. And I think it came true today, because when we started this morning, things were looking up. We were coming off after a very strong session yesterday. The Nifty had come within 10 paise of an all-time high. SGX, etc. were indicating a good start. By close, it looked very different. The Nifty, the Bank Nifty, both came under pressure. The Bank Nifty sold off, especially in the last 20 minutes of trade. And the Nifty closed below an important kind of support level. There's a rising channel and it closed below the lower end of it. So things were different. There was nothing very large in terms of cracks, but the sentiment did sour a little bit. Is it nervousness around all-time highs? Perhaps yes, because otherwise there was not very much in terms of reasons to explain the move. Now, what put pressure? The HDFC twins, there was a technical reason, dividend-related, Reliance, Kotak Bank and ITC. These 5 names were responsible for about 80% of the cut that we saw on the index. BPCL, ONGC, Coal India, resources companies were higher on the Nifty. Market breadth also completely evened out. It worsened as we headed into the close. But I have to say that the list of volume-led gainers is much longer and it's a much healthier looking broader market, even though it doesn't show up on that 1:1 advance decline ratio. So Astral, Mazgaon, Birlasoft, Hudco, Sonata Software, Repro, Sequent, Seat, Shakti Pumps, Taj GVK. I can go on with some of these names. Barbecue, which has been a dead and out stock, that came up as well. There were stocks under pressure, but, with volumes, it's a much smaller list. Zensar, Berger, Adani Total Gas, Dish TV were some of the names which were under pressure. As I said, the market has dithered. It's come off in today's session, and we'll need to see if this is an extended kind of consolidation sideways lower, or the market starts to find its mojo back quickly. And I think global cues will be important. We get the US retail sales number later tonight, and I think that will be a cue to understand how the US consumer is doing, because a lot of chatter around which way US markets are headed as well. Back to you.
All right, Prashant, thank you so much for that market take. In market opinion now, Dean Kim, head of global research product at William O'Neill, says the large cap stocks are performing better than small cap stocks. Listen in to his opinion on markets overall.
The market is constructive at the moment because it is trading above moving averages. The other problem we have is large cap continues to do a lot better than small cap stocks. So we have yet to see improvements in small cap stocks, particularly for regional banks, which continues to run to heavy resistance. But we are seeing some pockets of stocks that are performing well in technology, retail, consumer staples, while consumer cyclical, basic material, financials, and energy are lagging. Right now, there's very little resistance. The only resistance I see is at around 63,500, which was a December high.
Meanwhile, Atul Suri, CEO of Marathon Trends, says that the PSU index is consistently making new highs. He also bets on defense and auto ancillaries, among other sectors.
Let's take the PSU index. It's been the only sector index that has been consistently making new highs. But the PSU index has PSU banks, it has defense, it has something related to energy. So what we did at Marathon is we went out and created around 42 bespoke thematic indexes where we classified these themes. Electrical equipment play is really working out very good. The second sector where we think there's a very big trend is defense. Again, a subset of the PSU basket, but we don't have a sector, but we have created sectors. We find that defense was a theme that has played out very well last year. And that's the only theme which we feel continues to make new lifetime highs. If you realize that autos also, and more than autos, auto ancillaries. So you really need to look at markets more thematically and in a micro way. And we feel that these four sectors are really what's leading things ahead. And they're all at lifetime highs. And that's why I feel that these are actually the leadership thematic or the trends that are playing out.
Okay, that is some market opinion. Moving on to the second headline today, Bank of Baroda gained over 1% after a strong fourth quarter earnings. The bank reported a 168% jump in net profits on a yearly basis. Even net interest margins were up over 33% for the same period. Abhishek Kothari joins in with the key highlights. Abhishek, a strong show from Bank of Baroda.
Bank of Baroda has reported the highest ever return ratios in last 8 years or even more. The ROA at 1.34% and ROE at 24.8% are perhaps one of the best that you are seeing in last 8 years or more. So gross NPA ratio has come down to 3.79%, net NPA ratio below 0.9%. They are also one of the best that you are seeing in last 8 years or even more. Net interest margin, as you said, has been one of the highlights of the result. It's improved to about 3.53%, which is the best in last 32 quarters. Ex of Treasury, the core operating profit growth is about 27.3% YOY and about 9.7% sequentially, which is on the healthier or the strong side. So slippages have come in at just 1.13% as annualized slippage ratio, and it's below previous quarters numbers. Analysts like Kotak Securities were working with a higher slippage number of around 3,800 crores. Write-offs, they continue to remain elevated for fourth quarter in a row. Annualized credit costs is at just 0.13%, which is one of the lowest that you are seeing in the entire banking sector. So the book continues to grow at lower risk. RWA to advances, that has declined to about 71.9% in this quarter when compared to 73.8% in the previous quarter, and domestic loan growth of about 16.3% YOY is perhaps the best that you are seeing in last 14 quarters. So in terms of PNL, both the NI and PAT is ahead of our poll. Back to you.
Abhishek, thank you so much for that. But stay with us actually. Suryodaya Small Finance Bank surged over 1%. This is on the back of improvement in asset quality for the fourth quarter. Tell us more details.
Well, Suryodaya Small Finance Bank reported a good set of numbers. The deposit growth was 34.2% YOY and about 10% sequentially. The loan growth was robust at about 26.6% YOY and more than 12.9% sequentially. So take it with a pinch of salt that, in the EMI proportion, the principal repayment is coming down and the interest payment is higher, and that is why you are seeing AUM growth to be robust across many lenders. Asset quality has improved. Gross NPA has come down to 3.13% when compared to 4.23% in the previous quarter. They have sold down NPAs to ARC or asset reconstruction company. So net interest income growth is about 43.5% YOY and about 14.5% sequentially. You are seeing margin expansion. So net interest margin is at 10.4% when compared to 7.8% in the same quarter last year and about 9.2% in the previous quarter. So PAT has come in at 38.9 crore in this quarter when compared to a loss of 48.1 crore in the same quarter last year and about 18 crore of profit that they reported in the previous quarter. Back to you.
Okay, all right, that's about Suryoday SFB. In more earnings now, Astrode was one stock that did really well in trade today. It came out with a strong set of numbers in Q4. It was especially beat as far as the EBITDA is concerned. So revenues were up 8% this time for the company. EBITDA was up 36% to come in at 314 crore rupees. Their operating profit margins, they came in at 20.8% versus 16.8%. And profits were up 38% to come in at 199 crore rupees as well. Both the segments did well. Their plumbing business saw a revenue growth of 3.6%. Their EBITDA came in higher at 256 crore rupees versus 190 crore rupees. Margins came in at 22.8% versus 17.6%. Even their paints and adhesive business saw good growth. Revenues were up 25%, EBITDA was up 42%, and margins were higher at 15.1%. This is for the adhesives business this time around. Spoke to the management earlier. They said that margin improvement was led by economies of scale, value-added products. They're looking at margins of 17 to 18% in FY24. Volume growth should be around 15 to 20% in their pipe segment, and also the break-even of their sanitary and faucetware segment will happen by next year in the second half. That is, it's a good set of numbers there, and that's why the stock rallied in trade today, higher by 5.5%. The other one that I'm tracking is IOC. That was another number which was a beat on all parameters. In terms of revenues, it was a beat. The company reported revenues of 2.02 lakh crore rupees, which compares with a poll of 1.88 lakh crore rupees. The net profit was higher at 10,058 crore rupees versus a poll of 6,393 crore rupees. Margins at 7.6%, much better than the poll of 6.5% this time around. And it was largely led by their refining beat, where the company reported refining margins of $16 versus $12.7 per barrel, which was the poll. The petchem segment also saw a recovery this time after 2 quarters of losses. It reported a profit this time around. So revenues doubled on a quarter-on-quarter basis, and EBIT came in at 295 crore rupees versus a loss that the company reported at 616 crore rupees. So good set of numbers from IOC after HPCL also reported a beat in its numbers. With that, we'll continue our earnings coverage because Vesuvius raised over 20% on a healthy margin in the first quarter. This calendar year, the company reported a 65% increase in EBITDA on a yearly basis. Revenues also jumped 18% for the same period. Nigel D'Souza is here with more details. Nigel.
Well, Vesuvius numbers are very, very good. Before we get to the numbers, just take a look at the broad market share here in India. The broad industry size is close to around 13,000 crores or thereabouts. Out of that, RHI Magnesita, well, they have bulk of the market share. Coming in second position is Vesuvius, with close to around 13 to around 14% of the market. Now, these numbers look very, very solid, and there are a couple of reasons out there. One is the last quarter of last calendar year, that's Q4 calendar year 22. Well, those numbers were a little bit disappointing. So, because there was a degrowth on the revenue, just compare those revenues, Q4 calendar year 22 with the previous quarter, there was a small degrowth and margins as well came down. Now, in the first quarter of calendar 23, well, the street likes these numbers very, very much because there's a bounce back and the margins have come in at mid-teens. In all likelihood, the product mix could have worked in their favor, and that's why these margins look quite strong. Now, in terms of a PE valuations, well, RHI Magnesita on a forward basis, well, that's trading more expensive than Vesuvius, which is trading at around 22 times odd. The smaller player out there is IFGL Refractories. Well, that's much cheaper compared to both these two large players. And in fact, that stock as well has popped up on trade, though volumes were on the lower side. Now, what works for Vesuvius? Well, it's an MNC owned out there. It's the second largest player internationally as well. And their return ratios are very, very good. So if you compare just the last year's return ratios, well, the ROCE, it appears like it's at around 13%, but they're sitting on cash of close to around 550 to around 600 crores. So you deduct that from the net worth, and you'll get the core ROCE is nearly around 30%. So that's positive. And they also have a growth plan going ahead because in February they announced that they'll be investing close to around 500 crores. Finally, it's a tightly held company, so the promoter holding is at around 55%. And also you have a whole host of large funds in there. Today, the stock on fire. Back to you.
Thank you, Nigel, for that. Moving on to the third headline today, Berger Paints fell over 2%. It came out with a mixed bag in the fourth quarter. Net profits fell 16%. Revenues rose 12% on a yearly basis. Manglam Malu is here with the details. Manglam, what did the numbers look like?
Well, for Berger, it was a mixed set. The top line was good. It was a double-digit revenue growth, but the stock ended at the low point of trade because as the numbers percolated lower, we started seeing, weakness. So it was the weakness in your EBITDA as well as the net profit, which was lower by about 15% as well. If you just take a look at the revenues, the company's revenue grew by 11.7%, led by volume growth of 11.1%. But the EBITDA margins actually declined by about 70 basis points, and this despite gross margin expansions of 90 basis points, and that's primarily because the company, plowed back some of their gross margin savings into other expenses. They have a new plant in Lucknow which has opened, and they've increased their ad spends as well. So other expenses as a percentage of sales came in at 18.4%. This compares with 16.9%. And to add to that, there was a fire in their Goa plant, so for which the company had to recognize 22.2 crore as an exceptional loss as well. So as a result of which, we saw a decline in the net profit by about 15%. But by and large, for Berger Paints, the other reason why the stock ended at the low point of trade also was because it underperformed its larger peer, Asian Paints, and another peer, Kansai Nerolac as well. And ahead of the numbers, the stock was doing well. Though we did speak to the management and they guided us for improvement in EBITDA. So let's hear them out.
We will have double-digit growth this year as well. That's something which we are reasonably certain about. So there will be some improvements only because, the gross margin has improved, but there were some one-off expenses which we took this quarter, which was the Sandila plant which kicked off, so we had to spend some money there. So therefore, it dipped a little bit in terms of percentage in EBITDA, but that is going to move up again in the first quarter itself, and onwards it will probably be at a range of between 16 to 17%.
Okay, that is the word coming in from Berger Paints. Kalyan Jewellers surged over 1.5% despite reporting a mixed quarterly performance. Revenue and EBITDA saw a healthy growth, although profit declined due to an exceptional loss of 33 crore rupees. Ramesh Kalyanaraman, Executive Director at the company, says the company intends to reduce gross debt by 15% in FY24. Listen in to what he had to say.
We will reduce 15% of our gross debts. That's the target for the running financial year. And when you reduce your debts, we work with banks on a very traditional basis where we have certain collateral land parcels which have been mortgaged with banks. That was the traditional way of getting exposures in banks in our sector. I'm talking about because we started 30 years before, and that is how we have been getting exposures from banks. And once we pay back the debt, we will negotiate with banks to take out the collaterals which has been mortgage, and there are a lot of non-core assets, land parcels, which we will again liquidate.
That's about Kalyan Jewellers, but PVR also came out with mixed fourth quarter, PVR Inox that is, while the company reported a net loss of over 330 crore rupees. Revenues and EBITDA topped street estimates. Surbhi Sataria joins us with more details. Surbhi, a mixed bag for PVR Inox this time.
Thanks so much for that. So PVR Inox reported its first ever quarterly numbers post-merger, and it was a decent set of numbers. The numbers are not comparable on a year-on-year basis, but they were better than what we have expected. Revenue came in at 1143 crores versus a poll of 1192 crores. EBITDA came in at 264 crores versus a poll of 216 crores, and margins have come in at 23%. Now it has reported a loss of 334 crores, but profitability was impacted by several one-off items like an impairment charge and also some merger-related expenses. They've also chosen a lower tax, tax bracket in FY23 and have charged deferred tax of 134 crores. So that has affected the profitability as well. Now, when you look at the internals, the occupancy was weak. It was down about 300 basis points, but the average ticket price and the spends per head, that was higher both on a year-on-year basis as well as on a when you compare it to the pre-COVID levels. For FY24, the company plans to open 150 to 175 new screens, and this is net of the 50 screens that they're planning to close due to, operational underperformance. Now, what we have to watch out for in FY24 is whether they recover their ad revenues and also what is the occupancy trajectory going forward.
Surbhi, thank you so much for joining us for that analysis. In fact, Ajay Bijli, the MD, and Nitin Sood, the CFO at PVR Inox, says there is a volatility in content consumption trends, which is affecting occupancies. Listen in to what they have to say on the business outlook.
because the volatility is something which is very extreme. So if the movie does well, it does exceedingly well. And if the movie doesn't do well, then it completely tanks. So I think that volatility is something that has probably lasted longer than I thought. So it's lasted about 12 to 14 months now.
All right, we'll do one thing, slip into a break, but stay tuned. We'll be back in a jiffy with the other headlines. Welcome back. You're still tuned into Markets Today on CNBC TV 18. Let's do one thing and talk about the fourth headline now. Bharti Airtel was under pressure ahead of its fourth quarter numbers. The telecom major has reported a beat on the net profit and margins front. However, revenues came in slightly lower than street estimates. Reema Tendulkar joins in with more. Reema, what did you make of the numbers?
Well, consolidated revenues are a miss. The margins have come in ahead of street expectations and profits are largely in line. So consolidated revenues for the company have gone up by 0.5%. This is lower than street expectations of 2%, and the miss is on account of lower India wireless revenues. So we were anticipating the India mobile revenues to go up 2.8% in Q4, but they've gone up by just 1%. So that's the reason for the miss on the top line. Margins have actually done better than what the street was anticipating at 52.2%. It's ahead of our expectations of 51.5%. Profits are showing you a big jump of nearly 90%, coming in at 3,000 crore rupees. But remember, in Q3, that's in the last quarter, the company had an exceptional loss of 670 crore. When it comes to the India wireless business, as I pointed out, there was a bit of a revenue miss, and that can be attributed to flat ARPUs, average revenue per user. The street was anticipating that ARPUs would improve for Bharti Airtel in Q4, but they have not. They remain stagnant at 193 crore, and this 193 rupees, and this could explain the miss on the India business top line. Subscriber growth has been fairly strong, and a little more than 3 million subscribers have been added on a quarter-on-quarter basis, and 4G subscribers continue to be extremely robust at 7.4 million on a sequential basis. Back to you.
Okay, all right. That is Bharti Airtel. Thank you, Reema, so much for joining us and making sense of those numbers. To the fifth headline now, ONGC and Oil India gain after the government cuts windfall tax to nil from 4,100 rupees per ton. That is why oil and gas stocks were in focus today. Additionally, a fire at Alberta oil fields in Canada and US purchasing crude to build inventories led to rally in oil producers because crude oil prices were higher. Again, 2% overnight after the wildfires in Canada buoyed prices, but weaker than expected data from China, so prices fall in later trade. Manisha Gupta is here with the details. Manisha.
It's been a good start to the week for the crude oil prices, where we are trading off the kind of lows that we closed the previous week with. We actually have seen 14% decline in 4 weeks for the crude prices, but this week it started positive. We are back around that $70 mark for the WTI, and 75 is where Brent is meandering at this point in time. The dollar index, the volatility there clearly seems to be impacting, but initially the concern that the demand is weaker, which still is the case. Chinese numbers are on the weaker side. Saudi Aramco has cut official prices for the Asian consumers for the month of June. But what the street is reacting to right now is, one, the Alberta wildfires, which have led to nearly 280,000 barrels per day of crude output being shut, which is 3% of their total output. The second thing is the Department of Energy in US saying that they are looking to buy 3 million barrels for the Strategic Petroleum Reserve. Department of Energy also says that they will not be selling 140 million barrels of crude between 2024 and 2027, as was earlier decided. So we are looking at supply concerns. The extra supply that could have come from US also doesn't seem to be coming right now. The other point that the markets are watching is the OPEC and allies, which are out to cut 3.6 million barrels per day from the month of May until December, with the expectation that by the second half arrives, you will be looking at tightness into the markets. So while supplies are expected to go down, and that's where the banks and brokerages expect the crude prices to stay firm, but it really depends on the Chinese demand on how that goes on. The other important factor, of course, is the G7 conversation on sanctions now on the third parties which are buying crude from Russia but selling petroleum products to Europe and other G7 countries which have put sanctions on Russia directly. So various conversations happening, and the premium really seems to be building up in crude because of that.
Okay, all right, Manisha. Thank you so much for joining us. The crude price is higher, windfall taxes cut, good for oil producers, and that's the reason these stocks are in focus. With that, it's a wrap on this edition of Markets Today. Thank you for watching.